All right, so let's get started with stock valuation is almost useless. And then bear with me because you're going to tell me, Mike, you don't know what you're talking about. Of course, valuation is like super crucial. You don't want to pay a super high price for a stock and then it goes down. So it's pretty much like, okay, so let's go back in time, look at Alimentation Couche-Tard ATD stock graph. And then in 2004, we saw that the stock price was going up a little bit and then was pretty much dead money throughout the financial crisis and then skyrocketed until 2014. 2014, you made 5 times your investment. You look like a genius. And of course, everybody in 2014 will say, yeah, I kind of missed that one. Of course, you missed that one. It's up 564%, right? Well, you're pretty much wrong. The problem is it kept on moving up. So while you were thinking that stock valuation matter and that the easy money was gone with Alimentation Couche-Tard, well, the next 10 years kind of proved us that the company kept on growing revenue, kept on growing earnings, and guess what? Kept on growing its dividend on top of showing a very nice stock price return. So then, where it's coming from that you should not buy a stock at a all-time high or at a highly priced? Well, here's what happened back in 2000. In 2000, we have two perfect examples where Walmart and Microsoft for a full decade shows negative results. So you've been holding onto those stocks. They were growing their earnings, growing their revenue, and yet nothing for the stock price. Dead money. Even worse, you probably even lose a little bit of money at the same time. How come is that? Well, the problem is a lot of people bought Walmart and Microsoft at their peak level in 2000. And this is why I'm saying that stock valuation is almost useless. It is useful to not buy a stock at a crazy price. The problem, though, comes with stock valuation. It is super difficult to determine the right price for a stock. And I'm going to tell you what I do for my portfolio and how I use stock valuation metrics. Nothing too fancy because it works, but because it's clear and simple. But first, let's go back in time once again. Talking about trading at a all-time high where everybody thinks that the market trades at an overprice, such as 2017. Why did I select 2017? Well, the thing is, I quit my job and I received the pension plan amount in 2017 right before the end of the year. So on September 1st of 2017, I had slightly over $108,000 to invest. So when you look at this graph, you're thinking, well, since 2009 all the way to September 1st of 2017, the stock market kept on going higher and higher and higher. So of course, it is overvalued in 2017, especially towards the end of the year. A lot of investors thought market's overpriced at least 30-40%, expect a big drop, expect at least a correction, and things are going to change. So you should wait in cash and not invest, right? But here's the thing. If you had waited on the sideline during that time, chances are you never had another opportunity to buy stock price as it was in 2017. Actually, the S&P 500 more than doubled during that time, and the TSX was up by 54% between September of 2017 till August of 2024. On my side, my portfolio is up 146%. So it was half US, half Canadian. I got a little bit of help for the last few quarters because the USD was a little bit more than the Canadian dollar. But overall, I made the right choice. Now you're going to tell me, but Mike, yeah, that's easy. Inside 2020, when you look back, you took a big risk investing at a all-time high and you got rewarded and now you're putting that on your face. Yeah, fair enough. That's right. So you don't have to believe me, but you could believe JP Morgan, right? So JP Morgan did that research and I've already discussed that before, but they made the difference between investing at any day versus investing at an all-time high. And as you can see on this graph, if you invested at an all-time high, well, every single time after 1 year, 3 years, and 5 years, you did better on average than investing in any other day for over 36 years. I mean, 36 years worth of data, and we are being told that whenever you think the market is overvalued, you're probably wrong. And this is what's absolutely wrong with stock valuation, and it's that problem. You think you have a formula. You think that you can determine the stock price value and like whatever it would be a fair price value. And based on that, you're going to decide if you enter a position or not. So before I show you what I use as valuation methodology and metrics to know if it's a right time to invest or not, I want to take a second just to show you what it looks like for analysts, like certified financial analysts, CFAs, that are professional and they're making like hundreds of thousands of dollars. Some of them are making even more than $1 million a year. So if you think they're all clowns, well, I have good news for you. They are hiring. And if you think you can calculate the value better than them, well, stop whatever you're doing, because I'm pretty sure those guys are making a lot more money than you. And probably that it would be a very good idea to make $500,000 a year just by using your formula to determine the stock price of a stock. What I want to show you here, this is a screenshot from Refinitiv showing you some, not all, of the analysts that giving them their price target for the next roughly 12 months. So the most optimistic think that there's almost a 40% upside that Apple is going to reach a target price of $300 in 12 months from now. So deeply undervalued right now. At the other side of the spectrum, we don't even see it there because there's so many professionals calculating with having access to all kinds of computers and researchers and other like junior CFAs making the research for them. But the most pessimistic saw the stock price in a year from now around $180. So you go from 180 all the way up to $300, and this is your price range established by a professional that has all the resources that they could. And then again, if you're better than them, well, you can make over $1 million a year probably, because if you're making better than them, you'll be able to determine the right value for all those stocks. I'm saying this because I don't think that you and I can really beat those guys. And those guys don't even know what they're doing, because really between 180 and $300, that's a wide range, right? So then sometimes it's overpriced, sometimes it's overvalued. We're talking about the same company with the same professional. And this is why it is so difficult to make up your mind and pull the trigger and hit that buy button. So how do you fix this problem? How do you determine when is the right time to get in or not, right? Well, you know me, I would tell you that today is always the best time because yesterday is over. But I do have a few tricks that I want to share with you. And to show them to you, I'm going to move over dividend stocks and show which metrics and how I analyze them before I press on the buy button. All right, so we are back on DSR, and we're going to take a look at how you can pull the trigger or not on a specific stock. So assuming that you did all your research, now I want to buy Costco. So we're going to take a look at it and see how it goes. So Costco, I already have in my portfolio. I'm super happy shareholder, of course, because when you look at the dividend triangle, oh my Lord, everything is perfect, right? The stock price goes up, the revenue goes up, the earnings per share goes up, the dividend goes up, and they even pay a special dividend once in a while. So what's not to like? Well, maybe the valuation. So the first thing that I like to look at when I don't know if it's the right time to invest or not is I'm going to look at the average dividend yield versus the current yield. Why? Because on average, a business model doesn't change that much and the stock market appreciation doesn't change at all. So therefore, the stock price will usually go along with all the other metrics and the yield will remain relatively the same unless there's a big hype or there's a big lack of love here. So the forward yield for Costco is at 0.55, while the average of the past 5 years is at 0.70. Already, this is not looking good. It's already telling me, yeah, it's probably overvalued at this point. And the second thing I'm going to do is I'm going to look at the 10-year graph. So when I look at the graph, it's even worse. So you see the average here and then over the past 10 years, and you see how fast it goes down. And definitely right now, we are in overvaluation territory in terms of the dividend yield. The next thing that I'm going to do is the same strategy, but using the P ratio and the forward P ratio versus the average of the past 5 years. So already the past 5 years at 40 times its earnings, it's quite steep. But the problem is right now we're at 53. Next year we should be around 48 if the stock price remains the same and the company continues to grow its earnings. So definitely not a good sign. If I look at the PE ratio graph, I can see that the last time it crossed the line, it was around May 2019. And since then, it keeps going up. So now what it's telling me, it's right now the market is a lot more enthusiastic towards Costco than it was in the past. You can guess why, because revenue and earnings keeps on growing very quickly, but that also puts Costco in the overpriced territory. Now, am I going to take a hard move here and just sell it right away because now we're in this kind of territory? Probably not. I'm going to wait until to see the dividend triangle if it keeps on growing or not. But if I continue to see double-digit growth for all the metrics at the dividend triangle, I'm going to likely keep that stock. At this point, I would tell Costco is forced to generate strong results quarter after quarter, and they better not miss one, because of course if they do, then we're going to take a hit. Since I'm well into profit on this one, my investment thesis remains the same, very strong one, and the numbers are great towards the dividend triangle. I will hold on to my shares. However, I would feel definitely a bit uncomfortable right now to pull the trigger and buy it, considering that all metrics are telling me that Costco is overpriced. Yet, since I would not buy 10, 15, 20% of my portfolio into just one position, and if I enter a position today for Costco, it would be around 3%, I would probably still pull the trigger. You know why? Because the investment thesis and the numbers are a lot more important than the current stock price. Maybe it's going to be dead money for 2-3 years, but maybe it's going to continue to grow. I mean, I bought in 23 right here, and not knowing that after that it's going to be, it would have exploded. And back then it was still overpriced. So this is what makes it so difficult when you look at stock valuation. So in the end, some will tell you that stock valuation is at the pillar of their investment thesis. But in the end, when you look at it, most of the time it's just fancy calculation and you will be wrong anyway. So I rather spend more time determining what's the business model, how it's going to evolve in the future, what's the risk, what's the potential growth vectors, looking at the numbers, including the dividend triangle, the payout ratio, the cash flow metrics, and then growing my conviction to buy the right stock that are companies thriving at the moment with a pretty good chance to keep on thriving moving forward. If you want to know more on how to do that and to set up your own investment process, I've built a dividend income for life guide that will teach you why I am focusing on low yield, high growth stock, why they are more secure and better than higher yield, even and especially at retirement, how you can derive your income from that kind of portfolio, and also how you can build it in the first place. Isn't that beautiful? So you can download it for free. You just have to click on the link description below. You put your email there, and then you're going to be able to download the dividend income for life guide. So now I'm curious. Let me know how important valuation is for you. Let me know that in the comment, and tell me, more importantly, how successful you've been to determine a stock price along like the past decades, and maybe we can find a way to determine it together. So if you have a secret calculation, I'm all ears. In the meantime, I'm going to continue to invest with conviction using a strong investment thesis and the analysis of strong financial metrics. All right, guys, give me a thumbs up to subscribe to the channel, and don't forget to stay invested.